All right, first things first, let's put the spotlight then on Trifecta Capital. The company has hit the final close of its third debt fund at about 1,700 odd crores. Rahul Khanna is now joining in. He's a co-founder and managing partner at Trifecta Capital. Rahul, thanks so much for taking time out. To begin with, tell us a little bit more. You've hit the final close of the third debt fund. Give us more details.
Thank you, first of all, for having us on. Yes, it's an important milestone for us and the ecosystem. Trifecta Capital is now in its 8th year. This is our third fund. We'd actually started raising this fund in late 2021. We'd done a first closing in November of 2021. We started investing from the fund back then. And subsequent to that, we continued to raise capital till earlier this month, and having achieved the fund target and exceeding it to some extent, we decided to call a final close on the fund at 1,777 crores. The strategy of the fund remains unchanged from the predecessor funds. The idea is to continue to back high quality venture capital backed companies, businesses that we think have long-term prospects of being household names, and are looking for debt capital to enhance their growth prospects. We've now had the opportunity to work with over 150 companies in the last 8 years. Many of them have become household names, from a Misho to a Big Basket. And we continue to look for those outstanding founders that we can build long-term relationships with.
So there have been investments in the likes of a Zepto, the Good Glamm Group. Walk us through, the kind of startups that you will really be focusing on. What really makes the cut?
So, venture capital is thematic, and companies that bubbled up 7-8 years ago would have been, for example, in the realm of horizontal commerce. We then had a wave of vertical commerce. We then had fintech, edtech, agri-tech, etc. So with every vintage, the kinds of companies that we will see will change, because different teams bubble up and achieve maturity at different points in time. But more broadly, I think we look for businesses that have a clear use of proceeds, so that they can use the debt either to fund inventory, working capital, capex, deposits. We are seeing now some new use cases, for example, things like acquisition financing, share buybacks. So the use cases have grown. The ticket sizes to some extent have also increased, given that these companies are now much larger. And, by design, a venture debt fund is highly diversified. So we will not be deeply investing in any one theme. We will hope to diversify ourselves by investing across many, many themes.
So, Rahul, let's also understand what the kind of, funding trends we're seeing within the debt space.
Sure. So venture debt and venture equity are companion asset classes. And, we have seen a secular slowdown in venture capital financing, more so in the growth and late stage, maybe lesser so in the early stage. The bulk of our focus is Series B and beyond. On occasion, we also fund along with Series A or after Series A. So I will say that there has been a slowdown in terms of overall deal activity. As a venture debt ecosystem, we are still a small portion of the overall capital deployed. So we haven't seen as much of a slowdown compared to the equity venture market. That said, we're also trying to be disciplined and make sure that we're looking at these companies through a slightly longer term lens, making sure that they can service the obligations, even if their round gets delayed by 6, 12, 18 months. So I think the bar was always high on doing deals. I think in this environment, we're being extra cautious.
As we're seeing the inclusion of global indices, all of that really indicates that there has been an increase in foreign investment via debt. Is that increasing? Is that a trend that you're seeing picking up with more debt funding options now opening?
Yeah, absolutely. Even if we just look at the last 8 years since Trifecta has been around, when we began in 2015, there wasn't a single venture debt fund in the country. Today, there's probably close to 10. And if you look at the amount of capital absorbed by the ecosystem, that's gone from a few million to almost $1 billion of venture debt deployed last year. So I think there is increasing supply. I don't think this is an issue of supply. I think, of course, companies need to be able to absorb debt, and going too early means that we are taking undue risk. So I think as the ecosystem grows, given the success of us and several of the other venture debt players, I think institutional investors and increasingly global investors have started to see venture debt in India as a robust asset class, the same way that they see private equity or venture capital. And so I believe there will be enough supply of capital. I think the truth, though, is that venture is a cyclical industry, and there'll be years where things will be slow, and there'll be years where things will be very busy. We're sort of in that trough period right now. The market has been relatively slow, but there is enough dry powder available. There is no shortage of venture debt funding available. It's just the market needs to be able to absorb it. And, we will be best suited to pace ourselves with the right size funds that we manage. So I do think there's enough supply. Of course, there are various aspects of credit that need to come through, not just venture debt, but there are broader opportunities around supply chain financing, vendor financing, receivable financing. So I think there will be a lot more innovation on the private credit side within the new economy.
And finally, which sectors, according to you, look ripe for a good investment opportunity?
So look, we are seeing, maturing of certain industries. So fintech, continues to be one where there is still demand for debt because many of these companies use capital to further invest and lend. So fintech is an area where there was a little bit of a regulatory challenging environment, and I think much of that now is behind us. So fintech continues to be interesting. We're starting to see some amount of SaaS companies come of scale, and that is another use case that we're finding interesting. Consolidation, as the market goes through a consolidation cycle, we are seeing people wanting to buy other businesses or acquire related companies, and that's an interesting use case. And I'd say, other sectors that in the past maybe hadn't seen enough scale, like agri-tech, or, for example, some of the more classical B2B businesses, I think clearly they've shown that they can absorb a lot of credit. So we are still looking at B2B, we're looking at agri, selectively looking at more mature and different models in ed tech. So I'd say the opportunities are still very broad-based, but we're very mindful of the stage of these companies, the burn rates in these companies, and the path to sustainability.
Thanks for that, Rahul. Let's